Lemonade CFO Tim Bixby recently did an interview with Oppenheimer. I want to highlight two nuggets from that interview and explain why they're so important to Lemonade long term and to your own investing long term. So let's take a listen.
What do you think is most misunderstood by Lemonade by investors?
I think there's perhaps a tendency for a lot of companies to get lumped together as we've gone through this cycle of sort of over exuberance and now correction. And so I think, it was kind of fun while the party lasted. Everyone was excited and lots of funding was happening and stock prices were high. But the hard day-to-day work for us was very, very hard. And it was a big, steep hill we were climbing, and we were making a lot of progress. And we were getting rewarded for things we hadn't even done yet. And now the tables have sort of turned. The market is completely upside down versus what it was. Yet we're in a much stronger position. We're 2 or 3 times larger. We have 5 products instead of 1. We just closed our first acquisition. And so we feel from a business perspective, we've kind of executed every step of the way of what we set out to do 5 years ago, what we promised the public markets 2 years ago. Yet, if you looked at the stock price graphs or listened to the tech news, you would think the opposite. You would think we're a weaker company today than we were 3 years ago, and it's entirely the opposite. I don't think everyone's missing that, but I think it's easy to miss that if you're not reading the letters or attending the conferences or digging under the hood a little bit.
That's the thing. Lemonade has executed. They're about 2 to 3 times the IFP since their IPO. They went from 1 product at the IPO to becoming a multi-line carrier, launching pet, life, and car just in the last few years. At IPO, they had $300 million in cash. Now they still have about $1 billion in cash because they made the wise move of raising a significant chunk of money when the stock was at an all-time high or near that. The cross-selling of products between existing customers continues to grow. As loss ratios did go up, they're now coming back down as these newer products are rolling out further and further. And as customers stick with Lemonade, their loss ratios tend to improve over time, and they tend to become, of course, wealthier and buy more products. They've also rolled out their 6th iteration of their lifetime value machine learning algorithm that takes millions of data points and gives a probability of whether someone is going to churn, claim, or cross-sell. And so as Lemonade has tanked and was as low as $20 per share and even lower, I've continued to buy and will continue to buy because for me, the risk was still the same. But the reward only kept growing as the price went down. I mean, the risk was the same. The company could go bankrupt or be bought for pennies on the dollar either way, no matter what happened. So in some ways, I wish the stock was still at $20 or $15 per share even, so I could accumulate at those prices. But even at $30 per share like it is now, in my mind, the risk-reward ratio is incredibly favorable, especially after the recent earnings where I would say the risk side of the equation went down. This is why it's so important to think for yourself when you're investing. Put on your paper bag, ignore all the noise, ignore all the Twitter noise, ignore all the CNBC noise, any kind of narratives that are just sort of out there, and think carefully from first principles about your investments for yourself.
Are you surprised that the incumbents are not taking advantage of, the reset in asset prices to kind of add next generation capabilities, or does it just kind of reinforce the idea that the biggest, it's just too hard for them to change? It's just too much kind of creative destruction.
It's not a cost issue. It's not a cost issue. It's not a desire issue. It's a capability. It's just extremely hard to do what we do inside a big company. Think of it this way. If you had all the money in the world, which large insurance companies have a lot of money, and they wanted to hire our product and tech team, and they went out in the world and said, please come work for our giant insurance company and build product and tech at a giant insurance company, they can't do it. There isn't enough, you can't pay a high enough salary to get that team because that team wants to build super interesting data-driven technology. And so it's structural issues like that. They could hire some folks, but it would be very difficult to replicate what we've done in the environment we've created, where the product progress we make is extraordinary. They want to do it. They're trying to do it. They've made good progress. Some of these larger companies have done great things, but in fairly limited areas. The better they are, the better they become at disrupting things, the more they're disrupting themselves and cannibalizing themselves.
I think this is the most common argument against Lemonade and against companies like Lemonade. It's the idea that legacy companies will easily swoop in and copy anything unique Lemonade does and then crush these small companies like Lemonade. This is a lie. Legacy companies often fail to adapt to new technologies because they have two problems. One is they have a lack of experience from the core leadership, from the core decision makers of the company. In the insurance market, these leaders don't understand software or software stacks or building an incredibly vertically integrated company that is entirely digital. They don't even know who to hire to do that. And even if they kind of did or kind of knew who to hire, the second reason is an even bigger problem for them. It's their internal conflicting interests. If a large insurance company got serious about actually copying Lemonade, and it would mean laying off large portions of their employee base as more efficient systems replace many of the jobs.
Stanley Hudson, you are fired.
Your longtime employees, your longtime colleagues and friends, guess what? They no longer have a job working beside you or working on some part of your company. It also means they may cannibalize some of their customers and draw premium in the short term that may look poor or even look like they're headed in the wrong direction. They're also internally conflicted because they don't even have shareholders that are willing to look further into the future and accept risk and an up and down stock price. Many legacy companies have boards and shareholders that don't want to rock the boat. They just want to shoot for the safest thing possible. These large legacy companies are also culturally like a very huge ship. It's very difficult to slowly turn a maneuver or take any kind of shift because you have these internal conflicting interests, because you have management and key decision makers. They're really not experienced in these areas. It's really difficult to turn that ship. Meanwhile, a company like Lemonade is extremely nimble. Personally, this bear argument that these big legacy insurance companies are just going to copy and crush Lemonade so easily, I just don't buy that argument at all. I don't even see that as a significant risk. The only risk to Lemonade really is if they don't execute well enough. Their own internal execution isn't excellent enough. If you enjoyed this, make sure to subscribe, like, join my Patreon, and follow me on Twitter. And remember, it's in the bag.